uh, personal finance, where we had covered everything, including, we had covered the investments in debt fund, real estate, gold, financial literacy. Then we talked about the inflation, impact of inflation. So number of issues we have covered under personal finance, including the term loan, term plan and insurance and everything, and medical policy, everything. So what we thought in our trust group, no, because that we will exclusively talk on the stock market, equity this time. And many questions are asked by people many times. Is it the right time to invest? Where to invest? Kuch tip de do, kuch give me some stock names where I can invest, or when I should book the profit. Should I be long-term investor or I should book profit intermediately? So these are the questions which typically, everybody is asking. And the answer to that lies in the to the people who have made a lot of money in the market, like Ramdevji Agarwal, Rakesh Junjunwala, Warren Buffett, Vijay Kedia, Ridham Desai. All these people have made a lot of money in the stock market, and we need to learn from those people. And my passion is to listen this YouTube video from all experts. I am following these all top market experts in the YouTube, and I listen to their videos, make the notes, and from that notes I share in my stock market group. I'm running a stock market investment group from last June 2020. So almost now 2.5 years I'm running this group. I'm the only admin, and around 120 members are there in that group. And I keep sharing the good things and good videos, which are, aired by a lot of channels and some individuals also on the stock market from time to time, depending upon the situation. So I listen to that very passionately. One person show from Mr. Khandewal, I have listened to all his episodes and I have enjoyed. Many times the episodes are too long also, 1.5 hours plus, but I listen it very carefully, and I have make notes and share in the group also. So a lot of these, whatever I'm going to share is a learning and experience, whatever I've been doing from last so many years. Though I have not made a lot of money, but I am a constant investor, keep investing something every month. And I'm not 100% successful, but stock market is a never, it's a ever learning place where you have to keep learning. Nobody's perfect. You have to keep making mistakes and relearn it. So I've done that, and I've been doing this constantly. So I thought on equity, I will cover something today in more depth.
Thank you, Rafik. Yeah. Should we start, Rafik Bhai, now?
Yes.
Yeah. Okay. All right. Okay. Please take it again.
Can everybody see this?
Yes.
So I've made slides which I'm going to go through it, and on some of the points I'm going to keep explaining you. So many people ask when to enter the stock market. The best time to buy is when you have money, and best time to sell is when you need money. This is told by Ramdev Agarwal. So people have to keep investing the money, and they have to sell when they need the money. Always try to invest in the sunrise sector, because the sectors which are coming, new sectors, they give more returns than the old sectors. So typically we have to see the mega trend, like IT was a trend in 1990. So we have to look at the trend, in which sectors, new sectors are coming. I think 2 years back, the trend was digitization, and many digital companies came. I know some of those stocks are not performing today, but we have to look at the trend and invest in the sunrise sector. Currently, people are talking about EV. but not sure that which companies are really going to make out of it, because we are still at the initial stage. You will make money when you invest in crisis or bear market. So people should understand that money is made only when you stay invested. It's not that you invest in the good bull market and make the money. No, you really make the money when you invest in the downtime market. Okay, so when the market is there, when people are not interested in that stock, that is the time you have to look at the value investing. You always make money from the bottom up. Why is this written is because the top companies, we call it 50, Nifty 50, top companies, Nero, some sound is coming. Top companies, Nifty 50 or Sensex 30, those companies generally are already multi-baggers, and they don't give that exorbitant high return, though they are the safe bets. But many times the real money is in the bottom fishing, is in the small and mid caps. So people shop when there is a sale, but in the stock market, people don't want to buy when there is a sale. So this is a really what we can say. People in the stock market, they come when there is the sale, there is nobody's buying. When the stocks are cheaply available, like in Corona during pandemic, the stocks were available at a very low prices. People were afraid to invest at that time. And when the stock market is booming, everybody wants to invest in that. But in real life, when there is sale, people buy more. So as long as there is a population growth and productivity growth, you cannot go wrong. You have to invest in the right stock and hold it. So this is about India, that India is a huge working population. They are the productive, and they are also they are both. They are not only participating in the growth of the GDP, but they are also working as well as they are consuming. So as long India has a population and there is a productivity growth, we keep investing in the stock market. This is what typically is happening in the all successful market like Japan and even USA, where the growth of the countries are happened, and that's why the stock market has gone up. 90% of the people get returns less than index return as enter and exit at the wrong time, as they enter and exit at the wrong time. So people do not make money because their entry and exit point is wrong. So that's where you really need to study where to invest and what time to invest. I am not saying the timing, but I am saying the in which stock you are investing, whether that stock is expensive or cheap. You have to look at that. I didn't mean the timing of the market. I mean the value. Value you have to check before investing in that stock. And even for exit, you have to check the value. If there is a euphoria or the value is very high, you can definitely exit and book the profits. Invest only surplus money and never borrow to invest. Yes, stock market is really a risk. That is why the returns are there. But you should never invest in the stock market by borrowing the money, because there is no guarantee that you will get the returns more than the interest cost what you are borrowing. So always try to invest the surplus money and never borrow to invest. Invest in business which you understand. Now, this is what is how you can select the stock. Now, if you are in IT, then you have to search companies in IT. If you are in banking, you have to search companies in banking. If you are in consumer discretionary or consumers, then you have to look at the stock which are in consumer sector. So if you are in pharma, look at the stock which are in pharma. If you are in real estate, look at the stock in real estate. So the business which you understand, you should invest. Invest in companies where owner has a passion. This is very important, because the companies which have grown big in India, most of the companies which have become big are the family run business, like Bajaj or Mahindras, so Tata's, all these family run business. They were initially family run business. Now they have become big empires. But those Sanjeev Bajaj, Rajiv Bajaj, those have the stocks which have really given very good return, because owner had a lot of passion to make companies big. So we have to look at the owner's passion before investing in any stock. We have to look at that as succession planning also. Check the performance of the company from all stakeholders, like customers, suppliers, employees, and bankers before investing. This is a very important point. If your customers are happy, definitely you are going to make good business and stock is going to give good returns, because company is going to make more profits. If suppliers are getting payment in time, that means company's financial position is very good and their market reputation is good. They are going to get the money from the market for expansion, and they are going to make a lot of profits by growing the business. If employees are good, employees are happy, then they will work, retain the employees, and they can grow the company. And bankers, yes, if bankers are not giving funding, then there is a red flag. So if bankers are happy, then you have to look at the company's financial condition. How much is their debt? What is the financial condition of the bank? Are they paying their debt? Are they paying their interest? So all these factors you have to look. This is how the stocks has to be selected. 90% of the companies are not worth investing in. No use is investing. So no use. So use the process of rejection. So in stock market, there are 5,000 plus companies, but by process of elimination, you can rejection. You use the process of rejection, and you can eliminate. I know it's not easy to evaluate all 5,000 companies, but only some 10% of the companies will be worth investing if you really analyze their performance in depth. In a small cap company, you should look for an owner and with passion, a narrow focus, and a large addressable market. Now, there are many examples which were small companies but became very big. Astral Polymer is there. Many companies were small. Davies Lab. So many companies where they were very small initially, but they became Relaxo Footwear. But they became the market leader in their sector, and their stock gave very good returns. It should be zero debt or low debt company, and it pays good dividend. So we have to keep looking at their debt to equity ratio, because high debt means company, if tomorrow can fail to pay the debt, because many businesses are cyclical in nature, and with cyclical in nature business, when the things are going bad or down, company is not able to pay the debt. And we know what has happened with the Anil Ambani ADAC group companies, or what happened with JP Associates, or this one Vodafone Idea. So many companies have become bad in the stock market. Their reputation went toss because their debt was very high and they were unable to service the debt. So evaluate the past 5 to 10 years of performance. Now, this is the practice followed by some of the investors like Vivek, like Vijay Kedia also mentioned that he does a lot of study before investing in any stock. He observes the stock performance over the years, and then he decides to look into that stock. Check for market leadership. Market leadership, there are many sectors, like typically you see the glass is also the sector. There is a company in the glass which has become a market leader. Now there is a company which is making Solaris panel, that is has become also multi-bagger. So there are many companies which are market leader in their sectors. They enjoy the major market share, and they are market leaders. So you have to look for market leaders in the respective sector. High profit pool in the sectors. Now in the sector they make the highest profit in which they are investing, in which they are doing their business. Cost advantage versus competitors. This is also an important thing, that if the company is a leader, then they have a cost advantage because they can buy at a low cost. Typically, I will give the example of Mukesh Ambani. They are they are financially strong. So when they negotiate with anybody, they can get anything at a damn cheap price compared to competitors. And their power, their muscle power is very strong to invest or to buy anything at a low price. So they can pass on the low cost advantage to the consumers also. That's why they could capture the whole data market in the India, and they started giving data very cheap. Today India is having one of the lowest data cost in the world, and that is thanks to Mukesh Ambani, who brought this competition and went ahead of the competition existing player and pass on those cost advantage to the consumers. Everybody is happy in the supply chain. This I already mentioned. Check the trend sector movement. Example, pharma sector, banking, IT, real estate, textile, etc. See, typically when the sectors or trend sector starts moving up, you have to look at it. Many times what happens, there's any entire pharma sector goes down, or entire real estate currently is gone down. Sometimes entire textile industry is gone down. Nobody is looking at that. So you have to start looking at the trend if those sectors are started going up again, and then you have to catch that cyclical nature of the sector in the beginning of the cycle. Then there is a good way to make the money in the stock market, and choose the best stock in that sector to ride the movement and make good profit quickly. So trend is very important. Like typically Tata Steel, when the steel stocks were at low prices, till I think 2017, 16, 17, they were at low prices. Nobody was looking at it. But suddenly those catch eye, and all these pandemic and Ukraine war brought commodity prices at the top roof. And then all these stocks went up substantially. So you have to catch the trend and invest in the beginning, not at the end of the cycle. When the sector starts moving, money gets multiplied fast. You can spot multi-bagger stock. When sectors moves, means some good news is coming in that sector. Typically, chemical sector was a trend in from 1718. The chemical sector started going up. So many stocks in chemical sector has become multi-bagger. When stocks break out after a long time with high volume, then that is the time to invest. Now, here is a contradictory view. Some people say when it is at top, don't invest. But Maheshwari, he says that when people are in, stock is going at high and the volume is high, that means something good news is coming in that stock, and everybody wants to buy that stock, and that stock starts going up again. That typically that companies there, I will mention about the which is selling the undergarments. That stock went up so high. So when stock goes up,
वो e-cart का जरा tracking करके बोलो.
So many stocks, when they go at the peak at all-time high, you have to start looking at
Everybody's
investing
happy in the supply chain.
Then as more peg is not good for drinking. Okay, I will explain what is peg. And peg is injurious to health. Same is in the stock market. What is peg? Peg is a P, that is price to earning per share. Okay, that market gives P upon growth rate. So less than one peg is good. Higher peg is not good. Now I will give you the example. Suppose the P is 25 and growth rate is also 25. Then it is good. But suppose P is 100 and growth rate is only 25%. Then peg becomes 4. So it is not good. You will not get returns from those stocks. So you get return only when the peg is low. And for low peg, the growth rate has to be higher than the P. So typically, you have to start looking at investing for low P. And you have to look at the those stocks where which market has not looked at it. This is the contrarian view many people follow to make good money in the stock market. For example, P100 and growth rate 25%, the peg is 4, which is highly expensive. So what to consider before investing? Buy cheap stock. Now, cheap doesn't mean the value, price. People misunderstand by the cheap. This is totally misconception. People think cheap means 2 rupee stock, 5 rupee stock, less than 10 rupee stock, less than 20 rupee stock, less than 50 rupee stock. No, that is not the cheap stock. It's the misconception. Cheap stock is the low P, and your market cap you have to look. You have to look at the price to book ratio. Low price to book ratio is the cheap stock. So typically at present, if you see a lot of public sector banks, now, banking sector is going up because interest rates are going up, and banks are the biggest beneficiary of that, because for the loan which they have already given to the consumers, they have started getting higher money from the consumers because of the interest rates, because the RBI is changing the interest rates, repo rate. So many PSU banks currently are less than 1 price to book ratio. I have looked at Canara Bank, then Bank of India. Those stocks, I think, started going up from last 6 months. So if somebody had invested 6 months or 1 year back in PSU, then they would have made very good money in last 1 year in the PSU stock. So cheap stock means you have to look at low price to book ratio. You have to look at low PE, and also the market cap. You have to look at the management. This is very important. The company, its management is very important. Your owner has to be looked at it, but also the management. Who are the CEO? Are the CEO working in that company or they are changing frequently. All these things has to be looked at it. Earning growth of the company. What is the, now this data is available in all websites, including value investing, and then moneycontrol.com or Motilal Oswal, everywhere, ICCI Direct, everywhere this information is available about the growth of the company. You can look at the past couple of quarters growth and profit of the company. So if the growth is showing trajectory upside and also the profits are going up, then you have to look at investing in that company. So look at the PE, price to book, and PEG, debt to equity ratio. I've already told the product or service which you like the most and which is consumed by mass. This is very important, that whatever we are buying in our life, whatever we are consuming from morning to evening, we have to look at the product and service. And if you feel that is the best, suppose you are ordering the food on Zomato and you are very happy that your food is coming in a very short time, and you are happy with the quality and service, then you have to start looking at investing in the stock. So product or service means if you like that product very much, then you have to start looking whether this company's is listed in the stock market, and what is its current valuation, and can I look at investing in this stock. So we typically I go many times in DMart, okay, to buy monthly grocery, and I am keep investing in DMart, and I have got good returns from that stock. So this is a disclaimer, but you have to keep going in the place where you have invested and look how the people are buying those products. Then you will understand that this company is doing good or bad. That product or service has to be consumed by the entire 138 crore population of the India. Look at the corporate governance. Now there are many bad examples of corporate governance, as we know, including the Nirav Modi, Malia, Anil Ambani Group, JP Associates, Punj Lloyd, many companies which there were issues of corporate governance, and those companies are collapsed. Many education stocks also have collapsed. So we even Yes Bank is a classic example. So look at corporate governance. If the corporate governance is good, like Infosys standards, then you have to look at investing in that stock. Look at the market share. Now, these also information, if you really dig up in the detail, you will understand that the stock which you are investing, like this plastic chair is there, that stock is gone up, that has become multi-bagger. Your some AC companies, then that Gujarat companies which is selling cooling, that has become multi-bagger. So many stocks, they are the market leader in their respective sectors, but you have to catch these there when they're young. You can, when the child is small, you have to catch it. Now when the stock has come to 60 age or 70 age, then you will not get the returns. Then it's a past history. That's the multi-baggers of the past, not the future multi-bagger. So never look at the past. You have to look at the future. Earning per share. Now this is the total profit company is making divided by the equity shares. That is how you can work out the earning per share. So EPS is earning per share, what company is making per share profit for the company. So you have to look at the EPS. If the EPS is going up and it is good, then that means the stock is really good. Return on capital. Now many companies, they have the loans and the capital investment. You have to look at the return on capital. Typically 15% and more is good return on capital, is a good stock. Then market cap is also a very good trend, because if you look at the market cap of the company, now typically many these people, Mr. Sharma and many people who invest in the stock market in small cap, they look at the market cap when they are 500 crore, 1000 crore, that time they invest. And eventually when the market cap goes to 30,000 crore, 40,000 crore, then they book the profit. But we come to know only when they stock becomes multi-bag. So you have to really search for the stock when market cap is in the range of 500 crore, 1000 crore, and start looking at the investment in those stocks. This is a very important parameter. I will not say you should avoid very high market cap, but typically when the market cap is very high, the stock returns are not very high. Today, Reliance or TCS, or ITC, those market caps are very high, HDFC, but they are not giving very high returns. Okay, they are giving reasonable returns, but not very high returns they are giving to the equity holders. You have to look at the scalability of the business, whether the business has potential to grow. Now, typically, example is again the this one data consumption only, or phone companies, your mobile companies, internet companies. Now, all the scalability is important. How much penetration is there? How much they are adding? Now, this data is published everywhere, every month. How many cases they have added? How many mutual funds are purchased? How many vehicles are sold? So monthly, this data is published in the news channels and newspaper. So you have to look at the scalability and what is the potential to grow this business. Because everybody, as the population is there, everybody, every child will need two-wheeler. Every family will need four-wheeler. So you cannot rule out those sectors of two-wheeler, four-wheeler and consumption. Everybody will need food to eat. So you cannot rule out DMart or say Tata Consumer also. So thus that product is consumed by 138 crore Indians. Even insurance for that matter. Insurance penetration is very low. Right now, nobody is looking at that companies. Some of the companies are listed, but the returns are not good and nobody is looking at that. But we don't know, tomorrow they may become very big multi-baggers. Whether the owner is pledging the shares. Now what happens? These companies, they keep on expanding and they don't get money. They take the money from the equity market, they take the bank loans, but beyond a point, they can't get the loans. And banks ask them to place the shares. Then only they give the money. So they place the shares. Now pledging of share is not good, because tomorrow if he is not able to service those money, then the shares can go to the banks and bank can take the share. Then the owner will change. The company, he will not be owner once the bank takes the shares. So pledging of shares is not good. Shareholding pattern. You have to look at who is owning the share, whether it is owned by FIS or it is owned by DIS. Now these also data is available in all sites. What is the FIS holding and DIS holding? So typically these FIs, they have threshold. They will not invest in a very small stock, or even mutual fund. They cannot invest in a very small market cap stock. So these are all RBI guidelines for the mutual fund company. So you have to look at their holding also important, because when they invest, that means they have done thorough study, because they have very experts managers whose only job is to look at this valuation, look at the company's performance, look at their market share, market leadership, their debt, everything. So all these studies done in depth by these FIs and DIs, all these mutual fund companies. So when they increase their stakes in the companies, that means the company has a good future performance. Whether the company is high dividend paying company. Now you have to look at this. Some of the companies are paying typically 3 to 5%, but some companies even pay up to 10%. That is more than FD, just by dividend. So you have to look at high dividend paying companies. So that is very good returns. Your stock keeps on going up, value keeps on going on, plus you get the dividend. It is more important than just looking at P multiple and price to book ratio. So high dividend paying is more important. The company should have good earnings. Okay, the earning I have told, the dividend payouts, corporate governance, then good return on capital employed. These are the factors you have to look before investing. Good earnings, good dividend payouts, good corporate governance, good return on capital employed. India grows because of entrepreneurs. So look for company run by good entrepreneurs. Now, typically, this again, this data I will say is available in public domain. If you see the all award function, okay, all award functions which are happening by ET Now or CNBC or Economic Times, there are many award functions. Now, who are the people who are getting the awards in this function? I think Sanjeev Bajaj has got many times award in the past. Recently, Nykaa has got award, Falguni Nair, and many people get award. Zerodha owner has got the award. So we have to look at those owners, because when this jury, which is compromising of very talented people, cream people of the country, like Infosys owner and all those people, Nandan Nilekani, those are the people who select these winners, if those winners are public listed company, start looking at fishing at those stocks. Good company at the right valuation, growth should come. If the company is good and if the right valuation is right, then growth will automatically come. That means stock will definitely go up. Now, which are the companies you should avoid? Red flag to avoid companies. There's a frequent equity dilution, which I told, pledging the shares or selling the shares. Even pledging is bad and selling the share is also bad. Some equity owners, they keep on selling. Now, this happens wherever there are no, succession planning. Owner is not interested. He wants to focus in some other business, or he's aging. So he keeps on diluting his stake. So you have to avoid such stocks, because the future is not there. Then auditors changing. Now, this is a red flag. Now, this has happened in many cases where auditors have, changed, and where auditors have failed. Even those companies are red flag, because outside auditors, typically all these MNC companies, they give the red flag. What is happening? What happened in Satyam, is a typical case of auditor fails only. Then high debt company, you should avoid. Capital misallocation. That means money which is taken from the raise from the capital market is allotted somewhere else or siphoned. Related party transaction. Now, this is called money siphoning. Now, what happens? I have also seen this. It is rampantly happen in India. The owner is owning 5 companies, and he lists one of those company. And whatever money and good manpower and good orders he is getting, he is using all these resources of money, manpower, and orders in his other company, personal company, which are not listed. And there he is making a lot of money than this listed company. So this is typically happening. It is called related party transaction. So you have to start looking at before investing, whether this owner has other companies and what is his plan about those companies. Whether he's going to lease those companies, that is okay. But if is he really diverting those money from this company or people or resources or orders to some other company? This is rampantly happening in India because owners are hungry and they are into many businesses. Okay, so equity dilution is not good. Check if the promoter is selling his stock. That I have already told. Then what sector? If the sector does not grow, you may not make money. Now this is important. Now typically real estate sector is not growing from last 10 years. Then if somebody stay invested, he wouldn't have made money in last 10 years. So if sector is not growing, you will not make the money. Don't go after momentum stock. Avoid gruesome stocks. Now people lose money. Even I have lost the money in this point, that is going after momentum stock. I was owning very good stocks from Sisa Goa, then RPL, recently Aditya Birla Capital, but I sold that and went into the momentum stocks in ADAC groups and some other stocks. I went and I bought those and I lost money. So this is a mistake which every investor does. He thinks that the stocks is going up, means it will keep on going up. So this is the mistake which most of us do. We have to avoid momentum stocks and really look at the value investing and not go after the momentum. This is maybe played by operators and you become the guinea pig for that. Psychology of an investor. The most important before investing in stock is know yourself. You should know yourself, your psychology, temperament, and behavior. Now, if you see, information age is already gone. That means people know all the information. Today's stock market is not what 30 years back it was there. So every information is available with everybody on the social media, WhatsApp, everywhere, Twitter, everywhere information is available. So information age is gone. Then the analytical age, that analysis of the company, that age is also gone. Everybody knows it. Which company is having what earning per share, what is their debt to equity ratio, what is their quarterly earnings. So that analysis is also done, that all information is gone. Then what is left for investor to decide when to buy and when to sell? It is all psychology and temperament and behavior. These are very important, and many people talk on this topic nowadays because people make mistakes. They exit early or they feel FOMO. You have heard about FOMO. So FOMO is a feeling which you get and you invest in that, and then you end up in making mistakes. So are you ready to take the pain, sleep well, and do not get disturbed in case you make a loss? Now, if you make the loss, are you keeping your mental peace? Are you sleeping properly? If that is the case, then come to the stock market. Otherwise, don't come. You should be optimistic if you want to make long-term wealth in the equity market. It's very important. You cannot make wealth in the equity market if you're not optimistic. Now, Rakesh Jhunjhunwala was the most optimistic. Even Ramdevji Agarwal is the most optimistic person who have made a lot of money in the stock market because they are very optimistic and they made money in the long term by investing, remaining long term investor. So you make money in the stock market because others wait for you. This is very important. Now, in our business, what happens? We make money because we sweat. We means we, our family, and sometimes our employees, everybody sweats, so we make money. But in stock market, these people where you invest, they sweat and you make the money. Because what happens? They pay dividend to you. They do expansion. They make more profit. They share the dividend. They do the stock splitting. They give the bonus and the stock goes up. And when the stock goes up, you make the money. So somebody else is sweating for you. So that is why you have to invest in the stock market. So sell the worst stocks and admit mistake rather than selling winning stocks and booking profit. This is again mistake done by most, commonly mistake done by most of the investors. They say they hold the worst stocks, they don't admit their mistakes, and they keep booking the profit and winning. They're selling the winning stock. So this is a mistake which everybody should avoid. Winning stock, you should keep it, don't book the profit, and worst stock you should come out. I can tell you, I have heard about Nilesh Shah from Kotak. He had told about during that Dasera that we should clean our portfolio, like remove all negative things from our life, like Ravan. So I listened to him, and immediately whatever stock I had, I sold it, and I avoided further loss. So this is the typically we should do it. I think it is recommended that once in a year we should churn our portfolio and remove the worst stock and book the loss and keep winning stock with us, or add more stocks in the winning stock. Tips for investing. Now, investing is equity is very tax efficient as long as tax in equity is only 10% as compared to 20% in gold and real estate. Now, if you invest in gold and real estate, when you are going for sale, you have to pay 20% tax. In equity is only 10%. Secondly, in real estate now the VAT has come. There is a lot of infrastructure cost which builders are taking. For parking charges they are taking. For MSCB they are taking. So many costs are there. So actually what builder is quoting rate is much higher, less than what you are actually buying. Plus super built up issue is there. That we are anyway in Indian culture we have accepted that. So super built up we have accepted. But infrastructure cost, your parking charges, then GST, all this stock is additional over and above what builder is quoting. So in equity, actually, you don't make the money. Somebody else is making the money. And gold also, I had very bad experience. I don't own any gold. Whatever I had, little I have sold recently when I wanted to invest in my new mall. So gold is also, you don't make money. The gold smith makes the money while buying and selling. He makes the money. You don't make the money in gold. Hold on to the winners and sell the losers. This I already told. Now, again, one more important thing. Have a stop loss of 20% to minimize your loss. This is a facility available for all demat holders. But I have also not used this feature, but I think this is a strongly recommended feature that you keep your stop loss of 20%. I am told by somebody recently that he is keeping stop loss of 20% and also is keeping stop loss of 20% for higher side, and he books the profits. And eventually by doing this, he's making 20% profit. So 20% stop loss is a good idea, so that your equity is preserved and you don't make 90% or 80% loss. Keep focused portfolio. The more decision you take, more likely you are going to make mistakes. Now, this is typically told by Ramdev Agarwal that if you have a focused portfolio, he was owning 250 plus stocks. Then he went to attend Warren Buffett's annual conclave, which he goes every year there in USA. And he understood that if he remains focused, then only he will be able to make money. Because the more you buy the stocks, the more likely you will be able to make the mistakes. So focus portfolio is very important, and this is strongly recommended. Typically, I will say 25. Some people may not agree, because but this is what Ramdev Agarwal has told, that 25 or 30 maximum good decision if you take in life, then you will be making a lot of money. I think in the last Ascent Conclave, one of the person told in the Shark Tank, 5 गलतियां करो, but एक बार सही रहो. You can be wrong 5 times, but do it right once. So this is what in the stock market, I will use the same word, that you can buy 5 stocks wrong, but buy 2 good stock and you will make a lot of money, or buy 1 good stock, you will make a lot of money. Okay. So remaining buying good stock is important. Buy good businesses when they're corrected by more than 50%. Now this is very important. The companies are good, businesses are good. Now Nestle is not a gruesome company. It's a very good company. Colgate, Berkshire Hathaway, Warren Buffett's company, even those are corrected. Davis Lab was corrected. Titan was corrected. So many good companies, they corrected by 50%, sometimes 60% also. But eventually, those companies were good. Their business model was good. So they bounced back and they came to all-time high. Even today's Davis Lab is available at a very low price. Nobody's looking at it. I know it. It is at 3,600, but all-time high is 5,400. So many times good companies are available at correction value, but we don't look at it. So don't buy the companies in hopes that somebody will buy from you at higher price. This is very important. Typically, when we buy the stock, we think that somebody else will be there to buy our stock at higher prices. No, that is not the way to invest in the stock market. You have to buy the stock by looking at whether it is cheap, that P is low, price to book ratio is low, PEG is low, the quarterly profits are good, and the value is right. Then only you have to buy, not thinking that somebody else will tomorrow come and buy your stock at higher prices. Now, typical formula, which I have mentioned here, these are all lessons learned from the experts. 15% is a good formula. 15% for the PE, return on capital employed 15%, and growth profit 15%. Famous investment guru Mark Mobius has interviewed with Anuj in Iti Now. He discussed a host of issues including dollar currency, interest rates, gold, equity performance across the globe and his portfolio in India. As per him, return on capital employed and return on equity are the 2 most important factors. Return on capital employed and return on equity. The bull market ignores bad news, but it gets attention in the bear market. This is very important. In bull market, people ignore the bad news, but in the bear market, those bad news are hammered very badly. The bull market picks out when bull market picks out when P multiples are historically high. Okay, so this is again the entire stock market equity ka P jo hai, if it goes above say 30, that is considered as historically very high. Then price to book also typically more than 3 or 4 is considered as a very high. Then interest rates starts going up. So typically we are in this cycle, but we hope this time the interest rate cycle will not permanently go up. Inflation in India at least is quite under control. So in India, I think that the interest rate cycle will not go up very high. It will moderate. This is what my reading and gut feeling is there. You can make 10x in stock in 10 years if earning growth is doubling in 3 to 4 years in non-large cap space. So 10x return in 10 years is possible in many stocks. Here again, I would like to mention one point. I think it will come in the slide also, that we wait for 7 to 8 years to make money double in FD. 7 to 8 years to make money double in Provident Fund account, PPF account. We wait 10 or 15 years to double the money in real estate, but we want in equity money to return double in 1 year, 6 months, 2 times, 2 years. So this is wrong. You can make 10x if you wait for 10 years. So you have to look at earnings. Whether earnings are doubling in 3 to 4 years, then definitely the returns are possible 10x in 10 years. Start investing early age to get benefits of compounding. This is very important, that you have to start investing in the beginning and in a methodically, that is SIP format. Systematic investment plan in mutual fund or in equity also in SIP format. That means every month I will invest say 50,000 or 1 lakh, whatever I have put aside. In every month, in a particular date, I will invest. Irrespective of the market, is at high or low. Follow the 30-30-40 rule. 30% investment, 30% expenses, 40% housing EMI, term plan, mediclaim. So this is what is you have to look at. First, remove your 30% of the money from the profit as an investment. 30% do the expenses, live a good life, quality life, and use 40% amount for your housing EMI, term plan, mediclaim, etc. Current definition strategy. Now, what is large cap? Now, large cap as per the current market cap is anything market cap more than 26,900 crore. Mid cap is 6,900 crore to 26,900 crore. Small cap is anything less than 6,900 crore. So all stocks where market cap is less than 6,900 crore, they are considered as a small cap. In numbers, first 100 companies are large cap, 101 to 250 companies are mid caps, 251 to 5,000 companies are small cap. So now you can understand where the money is. It's not in the first 100 companies. It is in these 251 to 5,000 companies or in 101 to 250 companies. But many of the mutual funds are investing in these 101 to 250 companies. If you buy P between 10 to 15, the company grows at the rate of 25% for the next 5 to 10 years. It is sure shot multi-bagger. So if you are buying at low P, price to earning per share, okay, then 10 to 15, then definitely if the company is growing at 25%, then it is a sure shot multi-bagger. Market cap is one of the most important factors to see whether stock is cheap or expensive. This value is achieved by multiplying the total shares into current stock price. Now, how is market cap worked out? What is the current stock price into the number of equity shares? If you multiply, you will get the market cap. To protect your money from downside, when the market crashes, one of the tools which most traders use is stop loss. This can be used by investors who want to protect their profits or principals. Experts suggest stop loss of 20%. I had mentioned 10%. I had mentioned about 20%. It all depends upon the individual appetite. So 10 to 20% is the stop loss one should do it. This facility is available to all demat account holders. Only 1 in 8 small cap stock perform. Only 1 in 8 small cap stocks perform, so it is very risky. But it gives exorbitantly high return when small cap becomes large cap, means market cap increases. No doubt, small cap is very, very risky. I have given you statistics shared by experts that out of 8 stocks, 7 stocks does not perform in small cap, but 1 performs and that becomes multi-bagger. Now, if you own that and in a sizable quantity, then the market cap goes up and that small cap becomes large cap. Bajaj Finance was also small cap in 2009. You have to go through pain before the gain. Small cap investment requires patience and managing risk. Yes, it requires a lot of patience and managing risk. Only high risk appetite people are advised to invest in small cap. Small cap mutual funds gives high returns over 10 to 15 years. Typically, SBI and HDFC small cap are the market leader. They are giving very good returns. Investors tend to become aggressive when the market is at its peak. It should not happen. It should happen other way. It should be another way. We should be conservative when the market is high. Fundamentals can be used for long-term investment strategy. Never invest in falling stock or never average falling stock. I have made this mistake recently only when Aditya Birla Capital was listed on day 1 at 250 rupees. I invested and I kept on investing till it came to down. Ultimately, my average price was 146 and I made a mistake by booking loss in that stock. And today, the price has come to my purchasing price level, but I made a huge loss. So this is what I want you people to understand and avoid mistake like me. I had bought that stock with a lot of hopes that it will become multi-bagger. It has got 10 businesses. All those 10 verticals will get listed. I will get the bonus issues and all kind of thing I have thought. But I lost some of the patience and invested money in some other stocks and made a mistake. And today that entire value has come. And this has come because recently that Z Business host has given the buy rating for this stock, Aditya Birla Capital. So stock falling means something is wrong, which the fundamental of the company and the whole market knows about it. So never buy the falling stock. All big successful investors in life is changed by just 3 to 4 multi-bagger stock. This is very important. All big investors, now Rakesh Jhunjhunwala or Warren Buffett or Ramdevji Agarwal or many people or Vijay Kedia, all these people, they have become big people by getting 4 to 5 good stocks, or typically I will say less than 10. 7 to 8 stocks only, they have made huge money because they invested their large chunk of money in that stocks. That is why they those multi-baggers returns like Rakesh Junjunwala has made in Lupin and Titan, and everybody knows it. Ramdevji Agrawal has made in Hero Motors, Infosys, and many companies. People didn't invest. This is very important. People didn't invest from 1989 to 1991. They didn't invest in 1998. They didn't invest in 2001 to 2003. They didn't invest in 2008. These are the years where the market was actually bottom out. That means it was in bear market. And they invested in 1992 in Harshad Mehta bull market, 94, 1999 in IT boom, and 2007 infra and real estate boom. So people make the mistake by investing in wrong time. So starting and exit point is definitely important. You should not invest in when the market is euphoria. You should invest when the market is in bear market for getting very good returns. So it's not easy to catch the bull and bear market. So that is why they say you have to keep investing continuously in SIP format. If your stock is not performing over a period of time, you don't have to have over worried, as the outcome is not in your hand. You should follow the correct process. Results have to come good over the long term. Your process is correct. You have looked at the return on capital. You have looked at the market share, quarterly performance, or whatever you have looked at the P, price to book. Still, stocks are not performing. There are many PSU stocks which are not performing for whatever reasons. But if you are confident and your process is correct, eventually those stocks goes up. Today, all stocks of PSU has gone up from their low levels, whether it's SBI or Bank of Baroda or Canara Bank, Bank of India. Many banks have gone up from their lows. We have no control over the output, but we have to focus on the sound process. In the short term, luck can matter for returns, but for long term, the process leads to huge return or in success. Okay. So this is we should not just think on the luck, because luck can matter only for the short term, but long term, the sound process is the important. Typically, very good example of this process and luck I can give. Suppose you want to book tickets in PVR. You want to go for a movie. You plan well in advance. Say 5 days or 4 days, 5 days back. You plan it and you book the ticket. You get the seat which you want. And many people who don't plan it because of whatever reason, and they decide to go the movie on the same day, and they click the button, and some 2 seats are only left, and they get the ticket. That is called luck. So I think it's very rightly put. What is luck, and in the short term, what is luck? By chance you get those seat ticket, and if your luck is bad, you may not get the ticket. So, but planning properly, following the proper process for air ticket booking, well in advance for foreign tickets, then you can save a lot of money by doing the booking well in advance, even for hotel booking and everything. If a company makes a loss for a particular quarter, then deep dive the balance sheet and find out whether it's a one-time loss or temporary loss. The worst may be behind the company. Sometimes company do make the losses in PLN, but you have to look at the balance sheet and why those losses happen. Whether it's a write-off. Now PSU banks have done write-off. All banks have cleaned up. So that was one-time losses. So you have to look at those factors and what's maybe behind them, and the company may start again performing. Opportunities in the next 20 years will be far more than the last 20 years. Now this is a sentence given by Radhakrishna Damani. Okay. So last 20 years say next 20 years are going to be more opportunity in the stock market. So that's why I was telling, don't look at past multi-baggers. You have to look at which are the stocks which are going to become multi-bagger in future. When the market punishes the company and stocks are down by more than 50%, one can buy the stock whenever it is out of flavor and buy at a depressed value and when market cap is low. Never try to time the market. You cannot get bottom or top of the market stocks. Spending time in the market creates wealth. It's very important. Not timing the market, but spending time in the market creates the wealth. Spending time in the market is more important than timing the market. Market का bottom पकड़ना मुश्किल ही नहीं, नामुमकिन है, नामुमकिन भी है. Now I am coming to last few slides. Then I can take the Q&A. This is again question asked by many people. भाई कभी exit करना है stock को? When should I exit the stock? There is no one fixed answer to this question, as it varies from person to person, and on many factors like food appetite is different for different person. Some person will eat less, some person will eat more, some people will like veg, some people will like non-veg. So appetite is different for everybody. Some people will have from soup to desserts. He can eat everything. So the appetite is different for different people. Same thing in the stock market. If I don't need the money now, I can bear if the money is lying in stock market, then you can stay invested. You need not worry about the booking the profit. If you follow Warren Buffett and Ramdev Agarwal in India, they say to hold it forever and never sell. Many multi-bagger stocks have given good returns because people have held up for very long, between 10 to 40 years. Warren Buffett had invested at the age of 11 and he made his most of the fortune after the age of 60. For examples, few examples is Asian Paints. These are all multi-baggers of the past. ITC, Reliance, Infosys, Wipro, TCS, Titans, HDFC Bank, Maruti, Eicher, Axis Bank, MRF, Page Industry, Nestle, Jubilant Food, LMW, Bosch, Sri Cement, Lupin, Astra Polymer. This is a pipe company. Balkrishna Tires, Bajaj Finance, Bajaj FinService, Symphony I was talking, Cooler, Hero Motors, Bajaj Auto, Mayur Unicoats, PI Industries, Lexo Footwear I was talking, Torrent Pharma, Britannia, Gillette, Nilkamal. Again, this is a chair company I was talking. So these are the past multi-baggers. Ramdev Agarwal mantra: buy right, sit tight, buy good companies and hold them forever. It's not easy what I'm telling, but this is what he has been doing. And his portfolio, I can show you, as his portfolio has come many times from top to the bottom. That means from 100 crore it came to 30 crore, but from 30 it went to 250. From 250 again it came down. And today his portfolio is more than 2,500 crore. This is personal portfolio of Ramdev Agarwal. When Warren Buffett started investing at the age of 11 and made more money after the age of 60, that is why in stock market you have to stay invested for a very long. One has to sell his stock when he really needs money to meet his goals. Now, typically this is told that you should invest in the stock market as per the goals. Now, goals are common for everybody, whether it's a children marriage or their foreign educations or buying a house or buying a luxury car or buying a, going to the foreign trips. These goals are common for each and everybody. So when you want to achieve or meet your goals and you need money, you should book the profit. One should know the reasons why they are buying. This is very important. When you are thinking something before buying, you should know the reasons why you are buying and you should hold for that reasons. Watch for the sector. If the sector does not grow, then you may not get the great returns even if you had invested in good companies. When growth tapers, it is the right time to exit the stock. Now, some companies, the growth tapers. No, there is no further growth. Then that is a time to exit. Then you have to watch for the disruption also is important. Now, avoid the stocks which as a disruption. After Jio has come, many companies, telecom companies gone bankrupt, including Vodafone. So you have to look at the disruption in the field and avoid those stocks. The technology is going to become obsolete tomorrow, like fax machine. When growth tapers, it is the right time to exit. When you have to treat your small cap like private equity and exit after 3 to 4. This is typically said for a small cap to hold for 3 to 5 years. In small cap, there has to be entry and exit strategy. When a company's profit starts falling, that is the time to exit the stock as the stock has achieved its full potential peak. So when profit starts falling, you have to start looking to exit the stock as company may have achieved its full potential. Nilesh Shah, CEO of Kotak Mutual Fund, said during Dasera that clean your portfolio and remove bad stock. So we do with Ravan. I did it and saved from Anil Angani ad hoc stocks for the loss. You can churn your portfolio when you think this company is expensive and will not go further up. When P is very high, this is very important. Suppose you have bought at P 15 and currently P is 60. You can look at exiting the stock because you have already made the money. So when P is low, you can buy. When P is high, you can exit. There are few stocks that exception to this rule, like Adani stocks, where P's are very high, DMart, TeamLease, IRCT, Dixon Technology, IndiaMart, InfoEdge, TeamLease. These are very high P companies. Of late, trend is expensive stocks has become more expensive. When there is euphoria in the market, you can come out and book profit. When domestic global cues are not good, you can book the profit. When interest rates start going up, you can book profit as it affects corporate profitability. When oil prices goes up, you can book profit as it affects many sectors where oil is input material. It is recommended when you are near your retirement, change the portfolio and invest more in debt fund. 60 to 75% and 30 to 35% you can still keep in equity. These are the advice for the people who are aging. They can look at investing in the dynamic fund. In mutual fund, there is a concept called balanced advantage fund or dynamic fund, where when the market is at peak, they go to the debt. When market is at low, they go to the equity, and they reverse the percentage between 65 to 35. So this is what is recommended for the people who want to make good money even in equity through mutual fund. So this is for aging people. When a particular sector is badly affected, example real estate, infra, pharma, then book the profit. It's not that sectors are bad. There are people who have made a lot of money in Unitech, which is bankrupt today. There are people who have made a lot of money in JP Associates and Punjroyd. But there are people who have made losses also. So no stocks or sector is bad. You have to only catch the cyclical nature. You have to catch at the bottom and exit at the peak. That is how you can make money in the stock market. Now, nobody was thinking of steel sector 4 years back. But the people who had guts to buy Tata Steel and those stocks at low, they made a lot of money when commodity prices went up. Watch for disruption like Washington Post newspaper, Xerox, Kodak, Nokia. If in your invested business, if disruption comes, you will make a huge loss. Examples, Reliance Jio. Check if FIs and DIs or owner is selling the stocks you are holding. As I told you, this is very important. Who is owning the stocks and whether they are buying or selling. FIs are buying or selling, DIs are buying or selling, owner is buying or selling. This is very important. If owner himself is has no confidence about his company, why you should buy? But if owner is buying, then you should buy the stock. Because he knows the first where his company is going to go. Then you can come out of that stock. There are very few exceptions like Infosys and ITC, where owners have sold stock and still stocks have given multiple bagger returns. There are exceptions to this like ITC, Infosys, or even L&T or Bosch, where companies are not owned by single person. It is owned by so many people, even HDFC Bank, and still stock has gone up. But these are only few exception cases. When debt of the company is rising, you can consider selling stock, as the company may not be able to pay the debt in the future from earning, like Biani companies, all future group companies, then Suzlon, Syntax. These are the companies which they are unable to service the debt. Check whether funds are diverted to subsidiary company, which I already told. This is commonly done in India. Check if owners are siphoning money out of the business. Example, Satyam. Okay. I studied one company which is from our field, Precision Camshaft. Now, no doubt, camshaft has no future when EV comes. But what I've noticed in that stock is the owners are drawing 5 crore salary, both husband and wife, 5 crore each. Now, what is the profit of the company? And both and husband and wife itself are drawing 5 crore salary. Now, these are the companies we should avoid it. One is the sector is not good for the future. And secondly, the owners in themselves are drawing so huge salary, and which is not in proportionate to the profit of the company. If earning growth falls, that is the time to exit from the stock. So here I have completed my PPT. I have few points left which I can mention, and then in 5-10 minutes we can cover, close it. If management is not honest and hungry, then he will not become rich. So when management becomes rich, then only you can become rich. It's very important that you should invest in a company where management and owner is hungry, because if he grows, he becomes rich, then only we shareholder can become rich. शेयर बाजार एक समंदर है, कुछ लोग पैर धोने आते हैं और चले जाते हैं, कुछ लोग मछली पकड़ने जाते हैं अंदर, और कुछ लोग माइंस, ऑयल और हीरा ढूंढने को डीप अंदर जाते हैं. So I suggest everybody to become the third person to look at the mining, the oil and hira. Any business which gets disrupted by technology is to be avoided. If any particular sector is doing bad and stock is out of favor, look at capacity expansion of the company, as eventually earning will follow. Successful investing is all about pattern recognition of cyclical business. No single strategy works out in any bull market. Bull market keeps on going in every market. 1996 to 2000, IT sector, media. 2003 to 7, real estate, infra and commodities. 2009 to 14, pharma and FMGC. 2014 and 18, NBFC auto. 2020, digital. Identify right sector for growth. Look at total market cap of the sector. This is also important. Don't just look at market cap of the company. Look at the total market cap of the sector and put right bet. Warren Buffett put 30% bet on Apple and he was right. We should lose money minimum when we go wrong and should make maximum when we are right. We are ready to park money in FD and wait for 70 years to double, but we are not ready to wait for 10 years to make 10x return from stock market. Investment in stock market needs a lot of patience. Every investor learns only by making mistakes and losing money. When market punishes the company and stock is down, that I already told by 50%, you should look. Successful investment, I have told. Aggressive strategy cannot be substituted for high savings. Save high and take moderate risk, then saving less and taking high risk. Then this important formula is return on capital investment equity, EBITDA upon capital employed plus debt. Return on capital employed more than 40% is good stock to invest. If we filter to return on capital more than 20% for all 5,000 company, only 400 companies will become eligible to invest. Don't think how it would have been if you had invested 10 years ago. Start today and visualize how you would be filled 10 years from now. Many are long-term investors till next bear market, because in bear market they come out. Making as much money as quickly as possible is not an investment strategy. Unfortunately, for most of us, that is the strategy. There are periods of high returns, low returns, no returns, and negative returns. We need to go through all these to get long-term returns. From 2000 to 2020, trading volumes in Indian stock market went up from 5 trillion to 100 trillion. This is the trading volumes. That is 20x. Also, the demat account has crossed 10 crore, which was very less 4 years back before pandemic. Indian households saves $500 billion. Out of this, $250 billion goes to FD. Remaining $250 billion goes in financial assets like mutual fund, equity, insurance, debt fund. Financial asset is only 5% of the total assets of $10 trillion. USA's financial asset is 70%. In top 10 global financial assets, allocation is much higher than India. Means in top 10 global countries, financial allocation is much higher than India. Even 1% of $10 trillion, that is $100 billion moves every year. For next 10 years, financial asset will become 15%, that is $1.5 trillion, which is 3 times from the present $500 billion. This $1 trillion will go to different financial assets like insurance, mutual fund, direct equity, debt fund, etc. Please understand the difference between salesperson, product seller, and financial planner. Both are not same. Check whether funds are diverted to subsidy company, which is bad. You should look for financial planner. Even experts have their own financial planner. When everybody, including newspaper, media, is discussing about stock, example, Reliance Power, Suzlon, Educom, be away from that. Bear markets are bad is a misconception. Those who invest in bear market never lose money. People lose money when they invest in bull market and when market is frenzy or madness. It is better to learn from others' mistake because you have to pay heavy price to learn from your own mistake. Market cap, total market cap to GDP. This is also important, which market experts track. Higher the GDP, better the market cap. Currently, India is 60%. This was few months back. Now it is 1. USA is 1.5 times market cap to GDP. our market cap is $3 trillion and our GDP is also $3 trillion. But USA's market cap is $32 trillion and their GDP is $20 trillion. This is indicator for potential market potential to go up. This indicates whether market is cheap or expensive. Guys who forecast growth are well paid. This is very important. If you are able to forecast the growth of the company, please invest in that company. Growth is important, but value is also as important. In market, we have to look for hybrid, that is value as well as growth. Talk to analyst who is most bullish and who is most bearish to get the divergent view. This is very important. You should not only hear the goody, to hear from both the people. Great opportunities comes only in bear market. 2000 global crash, demonetization, COVID-19 in March 20 was great opportunity to buy. Career is reduced to maximum 25 to 30 years, but post-retirement life span is increased to 30 to 35 years. When you invest in stock market, you become part owner. So it's very important that you look for your post-retirement life. That is why equity investment is a must. When you put money in your, you become lender. When you give money, put money in bank, you become lender. When you invest in stock market, you become part owner. Never waste bear market opportunity. Reliance invested 500 crore in Asian Paints in 2008, which has current value of more than 10,000 crore. You have to understand economy, sector and cycle to make money. You make money in stock market because others wait for you. You have to look at intellectual honesty, management integrity, employee integrity, check whether CEO of that company has where he has studied, succession planning, rewarding to shareholders, differentiation to remain in the market, whether the company you are investing has a differentiation in the market to become market leader. If you look at all these points, definitely you are investing in the right stock. Thank you very much. I think I have covered in time.
Yes, thank you, Rafik bhai. We can take any questions if anyone has any questions or comments. Yeah.
Hey Nirav, I'm Amit this side.
Yeah, hi Amit. Hi Amit.
Great session, Rafik bhai.
Thank you.
I wanted to, talk about financial independence using the stock investments. What are your thoughts on the same, and how can it really be achieved?
See, if you compare the returns of everything, typically now interest rates have gone up, so FD returns have little gone up. But debt fund investment only will preserve your money. They will give you 9 to 10% return. FD will give you 6 to 7% return. Real estate, I told you, now returns are not there from 2010 onwards because there are many additional costs which were not there in 2004 to 7 boom. There is the GST factor. There is a lot of parking costs, infrastructure costs, which eventually you are not paid, stamp duty, which you are not paid when you are selling the house because the buyer also has to pay the stamp duty. So the real money is made in equity only. Only thing is you need to keep patience and you have to invest in SIP format systematically. You need not invest once and keep quiet. You have to keep investing. Suppose even if you want to invest 5 lakhs, you have to invest in 10 months. This is what told by experts. So in SIP format, if you invest and you keep doing this for next 10, 15 years, 100% you will achieve your financial freedom. I hope I have answered your question.
Yes, please. Thank you very much.
Yeah, so Amit, if I may just add, right, in 2003, that is when I started investing. At that point of time, index was in the range of 4,500 to 6,000, probably at the highest. And you can see in 23 right now, it is 60,000. So we are already 10 times up in terms of index, which means there are several stocks which has gone by 50, 80 times, while the index has gone up by 10 times. And I think like what Rafik bhai mentioned, the sources which if you listen to them and hear and read, right? I think in our lifetime, as the Nifty currently is in the range of 15,000, I will not be surprised that we will see a Nifty of 1 lakh in next 20 years. So there will be a tremendous wealth creation that will happen overall in next 20 years. Now, at least, I mean, everyone has a different strategy of how they would want to invest in stock market. But what has actually worked for many, and even I have tried it in last couple of years, and has reasonably worked, is the concentration of portfolio. You know, so instead of having 20 stocks, let's say if you have 1 lakh rupees to be invested and you invest in 20 stocks or 15 stocks. Probably what has really made sense is to invest in 5 stocks, the one which you have very high conviction, and then hold on to it for a very long period of time, you know, allow them to compound, you know. And I think if you do that continuously over a period of you know, let's 7 years, 10 years, I think there is a lot of wealth creation kind of can happen or rather will happen, right? So some of the folks that I have been following and who believes in this concentration portfolio strategy, they generally would say that you should probably at least have follow 80-20 rule. You know, 80% of your wealth should be in 20% of the stocks. You know how that's how concentrated one can be if that's the DNA of your risk taking or your ability to be calm when the market is up or down. But that is when the wealth creation can really happen. So yeah, maybe hopefully that can help. Yeah.
Thanks a lot, Nirav.
Yeah, thanks, Rafik Bhai, for a great session. Just wanted to ask you one question, saying that is it like good to invest on equities, or you should also look at mutual funds or somebody else fund manager to support? Like, what's the right way to do it?
Sir, if you don't have time to investigate and study about the companies, and you want to pay little safe, then I would recommend mutual fund. Again, in there are some rules. You have to look at the mutual fund right house, and you have to look at 1 or 2 large cap, 2 to 3 multi cap, 1 or 2 to 3 mid caps, and maybe 1 balance fund. So mutual fund also give reasonably returns anywhere ranging from 15 to 22%. Mutual fund returns also, and these are very good returns. But you have to keep patience, remain invested. Now, people who are during pandemic, you know, who saw their portfolio negative in mutual fund and they exited, they are loser today. But the people who kept patience and kept on continuing the SIP, see, in 2008 when stock market was crashed, only 8 billion worth of stock was sold by FIs, and stock market came from 21,000 to 8,000. But in last 10 months of this financial year, FIs have sold 50 million worth of equities, which is
Okay.
6 times more. Stock market has gone up because it is balanced by retail investor in India. Retail investors become so powerful that every month they are investing 12,000 crore plus.
Got it. Thanks.
Also, see, if I may just
you invest in continue.
no, please do it, Rafik bhai. Right. Yeah. So if I may add, CR, so like Rafik bhai mentioned, you know, mutual fund is obviously one model, but if you are still kind of keen to take a bit higher risk, then, you know, one can also look at PMS as an option. So there are a lot of good PMSs, portfolio managers, where the minimum ticket size is 50 lakh rupees to be invested, and they also give a return of 15-20% plus. You know, there are quite a few of them where they don't have restrictions like mutual funds, where there is a cap in terms of how much of equity should be invested or how much of money should be invested in single equity. And there are a lot of regulations that mutual fund generally will have to follow, you know, because there are a lot of small investors interest to be taken. But in PMS, that is really not the case. So they actually have the flexibility to go on and kind of invest heavily on single stock or kind of be on cash if they want to, right? So and these are very well managed funds with high governance and SEBI regulated. So that is also an option that I would suggest that one should look at it, closely.
Okay, thanks. That's what I had a doubt. Is it a good option? Yeah, thanks for clarifying. Yeah.
Nirav,
Yeah.
I wanted to ask you one more thing. So, what is a lot of algorithmic trading is really picking up, like Quant Fund is doing really well on the basis of this. How do you choose the right mutual fund and, consider the algorithmic trading or, the traditional based of stock picking to invest your money?
You're talking about mutual fund or this algo trading as a
Both.
Both, right? So I mean, I really do not have explored algo trading as much, but whatever I have read about it, right? I think there is these are all self-regulated programs with portfolio strategy of the person who is running this algo trading, right? Where based on their understanding, they have figured it out that these are the stocks that one can buy and sell. So the program is actually really doing it. So I am told, and whatever I have observed, there are certain algo trading options where people have made reasonably decent money. But the only downfall that I have seen, which really doesn't work for me, is because the kind of trading that they do throughout the year, which is something I'm not comfortable. So they do a lot of frequent tradings, which will attract your short-term capital gain, and that is more of trading rather than investing, So if you want to do more of quick trading and make money and kind of generate cash, yes, I guess that can work. But at least if you have a philosophy of to buy, hold, and do more of an investing, then algo trading probably will not make sense. Also on the mutual funds, what I have figured is that, there are a lot of good sites. I think the simplest one that one can look at is value research online. These are all credible sources where what they have done is they have rated the funds, so they have 5-star funds, 4-star funds, and so on. So of different kind of mutual funds that one would want to invest in, you can actually pick up good 4-star, 5-star fund. And then at least that's what I do it. I don't think that is any theory or strategy around it, but I don't have too many funds. So I have like 2 large cap, 2 mid cap, 2 small cap, 1 multi cap. I think not going more than 6 to 7 funds, and then, monitor that regularly for a period of couple of months or years, and that's probably has worked more for me. And
Amit, I will add you here. Sorry, Nero.
Yeah.
Rhythm Desai had said that I love traders because they keep the money on the table, which will take it. 99%. It is said that traders don't make money. They make money and they lose money. It's like a casino. So traders lose the money and investor picks the money. So that's what Rhythm Desai said. I love traders because they keep the money for us.
Got it. But if you look, there is a fund by the name of, one is Alchemist and one is Quant. If you look at their last 3 or 4 years performances,
Yeah.
Alchemist is something, they have a super special group also where I had invested, and the growth has been in last 3 years, it's about 6 to 7%. While in Quant, I did not invest a large amount, but I've seen a return of about 18 to 20% in last 3 years. So Quant is all about algorithmic trading. So if I'm investing in a mutual fund, so I'm not investing into their, I'm not doing the trading. They are doing the trading, which is run by an algorithm. So what do you think? Is it, should we balance it out, or should we, what is your opinion about this?
My opinion is avoid it.
Yeah. I also, I mean, not that I have invested, so I can say, but I think better to always look for funds which are managed by managers, who are keeping a close eye on it and trying to create wealth out of it. Because Quant is, I think they have very less control on this physical control is not as much, it's
Yeah.
more of program driven.
Correct. Got
I'll
it.
also quickly share what actually has worked for me in mutual fund. What I try to do is that, let's say if I want to invest 1 lakh rupees in a mutual fund, right? So I would invest in so let's say it's a Access blue chip fund if I want to invest in. So I will invest 1 lakh rupees in Access liquid fund. And then I will do an STP, which is systematic transfer plan, or from liquid to the blue chip fund. So I would do a STP of 1,000 rupees for next 100 days. So what I do is I want to invest in every single day in the market. So if the market is operating in 250 days, right? I actually invest every single day in the market, no matter what the market is doing. So my mutual fund strategy generally is not do SIPs, but do through STPs, and every single day I invest. So I keep a lump sum amount in liquid, and then every day that transfers are happening. So, and that can be as little as 500,000, whatever. I do 1,000, for example. So if I have 6 funds, in those 6 funds, the everyday purchases are happening. So even if the market is going down, it's getting purchased. And I've seen that returns have been phenomenal, because you are really not timing the market. You are actually investing at every drop, you are investing at every high, or even if it is flat. So just sort of sharing that,
Yeah,
Yeah.
that's a very good strategy. Thank you very much.
And let me add to this, Amit, what we were talking about this mutual fund quant. Okay, so what they are doing is they are doing a lot of derivative trading. Okay, hello.
Yes, Puneet.
Yeah, so they are doing a lot of derivative trading, which is futures and options and all,
Okay.
right? Which is a very risky job if you take it up yourself. So you end up losing a lot of money. But they have specialized, they trained a team who is doing for them, and they know how to trade into the market using futures and options. So if you believe in that okay, if that is what they have, if there is a constant return, if you believe it, and that's not and let me tell you, that's something which is it is an art also. It is something which you learn it over time, and this is what the most of the mutual fund managers do. Now let me tell you, let's say for example, any mutual fund, any good mutual fund, which is, let's say, giving you an annual return of about 10 to 12% a year. Okay, so if they are giving you 10 to 12% a year, how do you think they are making their money? They are making their money by two ways. One is that they are investing in long-term stocks. I mean, stocks for long-term, which they are getting dividends on, and they're getting the prices move up over time because they have all that time and energy and specialization to invest in those stocks and make money out of it. This is one way that they make money on your money, using your money. The second way is that they are also trading into the stock markets using futures and option strategy on a daily basis, and that is considered to be a business income or a business loss, right? So this is and they get, and I've learned that they make about 40 to 50% returns annually on trading futures and options, but which is, as I told you, which is an art, which is a science, and there's a lot of learning behind it. And those people, then they average it out. Okay, this is how we are making money on the on this futures and options trading, the derivatives one, and also on the long-term investing. And that's how they make money on your money, and then in return they give you 10 to 12%, or maybe let's say if they're giving you 18% for that matter. So that is also because they are making much more on your money. So now if you have the data, if you think that okay, this company quant, if they are performing well and you believe in that philosophy, then I think that I mean it's not a bad idea to invest in that also.
Got it. Thank you. Thank you very much, Puneet. That was really helpful. But my question across the board is that, say if I have a lakh to invest, do you think that, like what we do, blue chip, large chip, small chip, can we balance it out by investing into, let's say, something, and which is typically, so that you are not missing out on anything, let's say algorithmic trading or stuff? Is my question clear?
Yeah.
Okay.
No, I think if you talk to maybe a financial planner, he will have his own answer that okay, every time, I mean, let's say if you have 100 rupees or 1 lakh rupees to be invested, you should always balance it out across different funds, so you invest 50% in large cap, 30% in mid cap, and 20% in small cap, and that formula is something is probably very generalized, but I think it should go based on your personal this thing also, where that if you feel comfortable going little bit more aggressive on mid cap or multi cap, then you can increase that allocation, so that allocation should be maintained. I mean, generally that allocation is pretty standard in terms of large cap, mid cap, and small cap, or I personally do about, let's say, 40% large cap and at least 30% mid cap and then 20% small cap. That is my allocation. But then I have changed that allocation over a period of time. So if I keep rebalancing it every time in couple of months, so if I've invested too much in large cap over a period of time, I'll invest some in mid cap. But then I guess it's individual, maybe Rafik bhai can share what should be done, Yeah.
Actually, your strategy looks good to me, Niro, whatever you have said. But one thing I have listened about small and mid cap was that when the small and mid cap P goes above 30, then there is a big correction which had happened in 2017. And typically that time I was also fully invested in mutual fund in all small and mid cap only. But what sends me, I don't know, but I had booked all the profit from mutual fund and started investing in direct stock. So the market gives enough signal for picking out. The euphoria comes, like typically, say 6 months back, there was a lot of euphoria that or let's say last 1 year, there was a lot of euphoria that every IPO was getting oversubscribed by 200 times, 300 times. And all these digital stocks today, which has corrected by 70%, they were at very high price IPO. And there was a many times it was oversubscribed. So market gives you enough signal if you keep watching. And if out of these, whatever digital companies today they are listed, maybe one or two may become multi-bagger in the long run. Not all will not become successful, but you have to keep looking at them and buy when they come at correct valuation. They are corrected by, some of them are corrected by 60-70%.
Yeah. So
churning the portfolio is important, but maybe once in a year, not frequently, and keep the winners and come out of the losers.
Yeah. I'm just sharing some of the books which I found pretty interesting and quite helpful. So I've just shared it on the chat. I think these are, very popular one. I think anyone who's kind of up to date on the blogs, and they would know. So this is one that one can follow. Also, what I have also found, like Rafik bhai mentioned, so Vishal Khandelwal has a portal called Safal Niveshak, where I am their prime member. So he has two good courses. One is financial statement analysis and valuation, and second is mastermind value investing course. So these two courses are very good. He actually has gone in detail that if you have to read a balance sheet of a company or financial statement, what is it you should read into it, and it doesn't expect you to have a lot of accounting knowledge. If you have that, that's good, but it actually brings some sense to, so if you are, following few companies and you want to look at their balance sheet and P&L, what is it you should look into it? So these two good courses, I think I have found it quite helpful. Also, just one other tool that I use it regularly is screener.in, which I also find it pretty quite well, where if you have the normal user or as a paid user, it has the data of last 10 years, 15 years with very well analyzed data of companies, so pure P&L and balance sheets. If there's a company which is doing X amount of revenue, it will give a breakup in which segment are they doing it, how well they are performing quarter by quarter, year by year, and so on. So how are they doing in their competitive market? How are their competitors doing? So this is again a good tool that I try to follow. And one other series which, like what Rafik bhai mentioned, was must watch is Ramesh Damani's Wizards of the Lal Street. So that's a series which is there on YouTube, but again, it's they have picked up the best brains in the country, and they have actually, have spoken to them in terms of market. So a lot of insights one can learn, Yeah.
All these are shared in our group, in the past.
Yes. Yeah.
See, disclaimer, I will tell you, whatever I have done the presentation today, after listening to, I don't know the numbers, but I guess it will be more than 300 or 400 YouTube videos. But typically I follow, which and I like them the most, is Ramesh Damani, then Rakesh Jhunjhunwala, he is no more, Ramesh Ramdev Agarwal, then Nilesh Shah of Kotak Mahindra, then Vijay Kedia, then Nilesh Shah of Envision Capital also, then Samir Arora of Helio Capitals, Shankar Sharma of First Global, Ridham Desai, I love him most, Morgan Stanley, then Navneet Munot of SBI Mutual Fund. I like the most is Manoj Chokhani from Inam Security. He's also very good speaker. Sunil Singhania, who has started now his own Abacus Capital. Then there is one more is there. I forgot his name. Who was working in Reliance Capital and started his own now. So these are the people whose videos, and S. Naren, ICICI Prudential. He is a contrarian investor, and he's been successful on many occasions. Whenever he has won the red flag, or he has given contrarian view, those people who have listened to him, they have made money. So S. Naren is also very good in this thing, and these are the people whom I regularly listen to their YouTube videos and share, try to get the notes out of that.
Thanks a lot.
Any more questions?
Thanks a lot.
Cool. So I think we are very much on time. So I think if there are no more questions, we can wrap up the call. It's a recorded session. So we'll keep it on the group. Anybody wants to hear can hear it out. Okay. Thank you, Rafik bhai, for sharing.
Thanks a lot.
Yeah.
Thanks, Rafik. Thanks, Nirav. Thanks,
Thank you, Rafik bhai. Thank you, Nirav.
Yeah. Bye.
That was a wonderful session.